Hi, this is Craig with the Single Tree Team, broker by eXp Realty. Today I'm here with Drew Stiegemeier with Frontier Mortgage. We wanted to talk about the mortgage process and what it takes to get pre-approved for a loan. So Drew, is getting pre-approved for a mortgage difficult, and what is needed?
Craig, really it's a pretty simple process. And the first time I have a conversation with a potential borrower, I let them know it boils down to three things: assets, income, and credit. And when I say assets, that refers to, have you set aside any money for a down payment? And when I go to income, you have a steady job, and have you had a 2-year work history? And then the third part, a lot of people don't know. When I ask for credit, they have an idea of what their score is, but that's something we look into on our end. And typically after that conversation, we identify if you're W-2'd or a self-employed borrower. And if you're W-2'd, which the vast majority of clients are, all we're going to need are 2 years of W-2s, pay stubs that cover 30 days, the most recent 2 bank statements, a picture of your ID, and a simple online application. Most people can pull this together within 15 minutes. And normally within an hour, we can turn around a pre-approval letter and say, hey, here's what we can afford, and here's your options, and turn them loose. So it's a very simple process, nothing to be afraid of.
Perfect. Okay. So I have buyers that call me and said that they want to wait to get pre-approved until they find the right house because they don't want unnecessary credit dings. How much does a credit inquiry affect your credit? Are there other issues that could arise for waiting to get pre-approved?
Well, I guess in answer to your first question, the credit inquiries really have a very minor, if any, effect. Most people don't get their credit ran all the time, and the credit bureaus understand that people use their credit. So if you're getting your credit ran continually for a car, a credit card, and now mortgages, yes, you could see an impact. But if you're the average American getting it run once every 120 days, it's not a big deal. So I would not fret about getting your credit ran up front. It's something that definitely will help you shore up that pre-approval letter and make sure that you're ready to go as we go through the process. And then in the second part of your question, waiting to get pre-approved is typically going to be the difference between you getting the house and not in this market.
Sure.
By the time you've seen it, 35 other people have seen it, and everybody's ready to write an offer. So we want to make sure that we have it all set up front. You understand what it is going into it. You understand what the payments are going to be and everything else. And you have to remember your pre-approval letter is good for 75 to 90 days, depending on the closing date. And we may only need to get a couple updated pay stubs and a bank statement in that time frame. But, and it's good on any property. So say the first one doesn't work out, it's not like we have to redo this process again. So this is something you should always get done up front. Take it with you, because then when you do find the right house, you're ready to write, and you potentially can beat all the other people writing the offers as well.
Fantastic. So silly question, but why does the amount that a person pays in rent not exactly correlate to how much house that person can afford?
Well, I did some digging on this one, and the best thing I can say is that pre-COVID, 19, 20, before everything broke down, it was fairly linear. Like, hey, this is what I pay in rent, this is what I can afford. But over the last couple of years, and the vast majority of, 80% of the clients I deal with have some student loan debt. And while they are not paying on this debt right now, it factors into what's called the debt to income ratio. We use a calculation that's basically your outstanding balance times 0.5%. So every $10,000 is, $50 a month on a payment. So, that part of it factors in because it's not a linear equation. We are specifically set to our guidelines for debt to income. And when I say that, that's basically your debts that report on your credit report plus the new house payment, over your gross income. So that's a percentage. And typically you can go up to 45% of your gross income can go towards all those items. So it's just held in a different regard. While you may be comfortable making the rental payment of more than what your mortgage was, if you're over that 45% threshold, typically that's it. And the reason that most people exceed that now is that we've all forgotten our student loans weren't being paid. Now they're starting to come due. And it's been that way the whole time. The banks have always made you give credit for that. But now it's been long enough that consumers haven't paid that they're thinking, hey, we're paying all this in rent. Well, you need to take this into consideration as well. So,
okay. What type of loans do you work with?
So we work with any property that's a single family home up to a 4-unit, condominiums, and the financing styles are conventional, which that's typically what you need for a condominium, FHA, VA, and then rural financing, so USDA loans. We work with all of them. They're all in-house underwritten and funded. So we work like that side as a bank, but we are not a depository institution. So you won't pay Frontier Mortgage your mortgage payment. It'll go off to a servicer, but you'll never know any different. It happens right at closing.
Okay. What is the lowest credit score that you work with? And before you answer that question, second part of that is there extra finessing required by a buyer that has a lower credit score to get the deal done?
Yeah, so our minimum credit score requirement is a 620. That's the lowest that our investors will work with. And, in the term of finessing, it's not just having that 620 credit score automatically qualifies you for a loan. Typically, the closer you get to that number, the lenders are looking for what they call compensating factors, whether that is, hey, we have a lower debt to income ratio, or we're putting a little bit more money down. So say this is an FHA loan. Instead of putting 3.5% down, we're putting 5%. Or, they want to see 6 months of reserve for your mortgage payment after closing. So that may mean you have to have a retirement account. But the closer you get to the lower end of the spectrum, the more stuff the bank wants to see you have as far as compensating factors to overcome that. And whether it's right, wrong, or otherwise on the credit score, that is the all important thing right now as we get into the middle part of 2023.
Okay. And do you work with grants?
We do in Missouri. We partner up with the MHDC program, and I made a couple notes on that one. So basically what they do is they give you up to 4% as a first-time buyer. That can go to 4% of loan amount can go towards your closing costs and your down payment items. They require a minimum $1,000 investment. Their minimum FICO score is a 640. So if you have a 620, you don't qualify for their grant program here in Missouri. The loan is forgiven over a course of time, but you could be in a situation that it's owed back if you want to refinance, if you want to sell, whatever else within their allotted amount of time frame. And we can get into more in that, but that is typically the best grant program in Missouri. That's the one we work with. It's called the MHDC First Place. So that means you're a first-time buyer, haven't had home ownership in 3 years, and that's the one we go with.
Okay. Do you have grants that you work with on the Illinois side as well?
IDA is the one in Illinois, and we did not re-sign with them for this year. They made the process a little bit more laborious as a correspondent lender, which is what we are.
Okay. Last question. Do you have any words of advice for buyers in this market about getting pre-approved and just about the mortgage process in general?
Well, we talked about it earlier, like the importance of getting pre-approved right now. That is going to be the difference probably between you getting the house and not, because to sit and wait for a pre-approval, especially on a Sunday afternoon, it's hard to get one turned around lickety split. That could be the difference between doing it. And the other thing is don't be afraid to do it. There's no issues with applying. Even if it doesn't work out, come up with a plan so hey, here's where we are right now, and here's what we need to do to get into a house. That is the most important thing. Even if you don't qualify for the house, this will set you up with a plan to at least get you there, or tell you, hey, here's what you need to do to do it, and understand what goes into it. Because to walk into it blind and saying, hey, we're going to spend $200,000 on something, it sounds really crazy when you say it with really no foresight. It's like, hey, let's do a little research. Let's figure out what the payments are, understand it. And again, not a scary process. I'm always happy to help.
Great. Thank you. Thank you, sir.
All
Appreciate
right.
your time.
Craig, thank you.